Hi, good evening. This is series 2 of 3 of candlesticks. All right. In the first candlestick video, I have talked about high test bars and low test bars. Today, we're going to continue and talk a little bit more about the difference on the doji and the difference between a high test bar, low test bar, as well as a doji. All right. So to understand doji, which is an indecision bar, all right, one has to understand the size of the candlestick body. So a long body, if you think about it, is kind of showing strength. If you right, what it means for you have a long body is when you have an opening price. Let's say this price is moving in the upwards direction. Okay, price goes up and closes at the end of the day over here. So if you color in the body, okay, this is how candlesticks are formed. You get a big body. It means that a lot of buyers came into the market, pushed the price up, and finally ended off the day over here. As the bodies become larger, it shows an increase in momentum. And when the bodies become smaller, it shows slowing momentum. So in terms of sizes of the bodies, you can actually kind of compare how much momentum a price has by the size of the body in that sense. All right. And it also shows how far price has traveled over the duration of the candle. All right, be it 1 hour, 4 hour, or daily, the size of the body will just indicate in the entire day price open and traveled this way, or in the entire hour price open and traveled this way, or in 4 hours price open and traveled over this. All right, so it just shows the amount, the distance the price has traveled over the period that we're looking at. Once you understand body, we can talk about the tails, all right? So compare a body of this amount versus this amount, showing you the momentum. What we are missing now is just the tail. So this would be an example of slow momentum, means price open here and just traveled a little bit and then closed at the end of the day, all right, in the explanation of momentum. We are going to talk about the tails, which is called a wick, a candlestick wick. All right, because it kind of looks like a candle, therefore with a thing sticking on top, so it's called a wick as well. So in terms of candlestick wicks or tails, the wicks actually shows the volatility of price movement. So earlier in the earlier slide, we spoke about candlestick size. Now we're going to talk about the wicks, the tops and the top bottoms. So larger wicks show that price has moved a lot during the duration of the candle, but got rejected. Now this is an important part, because using this as an example, what it means is price opened, for example, price opened here. I'm going to use a buy signal. Price opened here, O, goes up. Okay, price goes up, and what it happens is price goes higher and higher and higher. Okay, but it got rejected. Okay, so the sellers came back in and rejected it and pushed the price down until the end of the day. It closes here. So this is how we get the high. Price was rejected at this area, but it has also traveled a distance. So when the candle wicks become larger, it shows an increase in volatility. So especially where we're looking at areas with a lot of what we call a lot of wicks, right? Very spiky price action. Usually it's a sign that, you know, there's a lot of volatility in that period, because what is happening is price opening, and then, you know, it has very big movement in terms of tails, but then the body is just like that. So if you have a lot of these candles with normal size body and very long tails, you know, it can mean that there's a lot of buyers and sellers coming in, pushing for position, and it's a battle to see who wins or lose, right? So there is a lot of volatility. That's why you get such high prices and such low prices, all right? And this often happens after long trending phases before a reversal happens, or even at major support and resistance levels. So when you are reaching a major support or resistance levels, a common thing that happens is buyers and sellers are fighting for position. So let's just say this is a support resistance level. Okay, so as price opens and is moving upwards, what happens is the sellers are coming in. The sellers are coming in trying to push the price down, because at a horizontal level where everybody, a lot of retail traders are looking at, a couple of things can be happening. People can be profit taking. People will think that this price is cheap. It's a good time to get in. So there's a lot of activity happening here depending on your position. All right. So a lot of sellers will come in and they will try to either sell off their positions for profit, or they think this is a good price to sell. They'll sell this position. So it end up, but yet a lot of buyers think that price will go up to a certain point. So there's this battle coming, right? And then, but in the end, it didn't close, right? And price gets rejected back downwards, for example. All right. So this resistance levels, a lot of times, when we have buyers and sellers coming in to fight for position, you can form candles with long wicks where the fight is happening. All right. So which is one a lot of our strategies when we trade on price action. A lot of times we look for high test, low test bars. We're actually looking for price rejections of a certain area, be it a horizontal level, be it pivots. Okay, and when we talk about dojis, what happens in a doji is the same price battle that has been going on. Okay, and what we're looking at is, at the end of the day, where did price close off? Okay, so in a doji, the same story happens is when price is when price started over hang on a minute, when price started over here, for example, when price opens over here at the top, buyers and sellers are coming in, fighting for position, forming this long wick over here. But at the end of the day, price actually closed very near the opening price, forming a tiny body. And if you have long tails on either side, it just means that on this day itself, there's a lot of volatility because a lot of buyers and sellers are fighting for position. But at the end of the day, who won? Nobody actually won, because the opening and closing are still around the same area. And that is why we call a doji an indecision bar, because at that particular day itself, there was no clear winner. There was no clear buy winner or sell winner. So it's a way of saying that when you look at the price, it didn't move anywhere. A lot of people are fighting for positions. Is this a buy market or a sell market? It's still a question mark. Hence, it's an uncertainty. So dojis happen when there's a lot of when there's an uncertainty happening, when buyers or sellers are coming in, but no one is actually stronger, because they're all still fighting for a dominant position. All right, so this forms the candle with a small body and a long tail, and it creates uncertainty, and it also indicates uncertainty because the sellers don't dare to sell too much, buyers don't dare to buy too much, because they're all trying to figure out where is it best to go. So end up price actually kind of closes the same area as the opening price, so forming the doji. Okay, this is an indecision bar. Where it's found, it is also often found at areas of support and resistance as well. This is the end of the doji explanation. Do join me for my last video on engulfing bars.